in listen-only mode.
Good evening, ladies and gentlemen. Welcome to the month of May, 2017 Self-Made Superfund Club Client Mentoring Evening. Tonight, we're lucky to be joined from the Head of Accounting of the SMSF Club, Gavin Conyers. Welcome, Gavin.
Thanks, Justin. Happy to be here.
Great. Look, just before we start, we've got to go through the important information. As always, we've got to go through the disclaimer. One thing about this presentation, we're going to go through a lot of the stuff about tax and the recent changes to the superannuation rules and regulations that come effect 1st of July. Likewise, discuss briefly the proposed changes, again, even more changes to superannuation in the budget that came out a few weeks ago. But as the SMSF Club, we are licensed through RM Capital. We're a corporate authorised rep of RM Capital. Tonight's presentation, like the majority of the information we do deliver our clients, is what's called general advice. General advice just means that we haven't considered your personal circumstances. When we look at the main reason why the majority of our clients and the majority of people set up a self-managed super fund across Australia, it is to take control of their retirement savings. So they want to make decisions themselves. Here at the SMSF Club, I suppose what our difference is from an accountant or other financial planners is that we're trying to give you the right information, so not just that you're compliant, but also you can make more informed investment decisions. So that's our motto, that's our business, and that's how we fit into from a compliance perspective. So this presentation and anything that Gavin or I say is generally in nature. It's not specific advice, but do speak to your advisor or your external financial planner to see how some of the strategies we're discussing tonight can apply to you as an individual. That's it from me tonight, just covering the disclaimer. And if I have any questions, I'll ask Gavin along the way. I'll also be monitoring the question section of the webinar. So if you have a question at any time, by all means, put it into the question box. Just because you put it in doesn't guarantee I'm going to ask it. If it's a good question, I will. If not, we might wait to the end to cover off the rest of the questions if we have time. So over to you, Gavin.
Thanks, Justin, and good evening, everyone. Just a little bit about myself before I actually start on. Let me just move the slide. Name is Gavin Conyers, and I look after the accounting side of the SMSF Club. I'm also the SMSF coach in Victoria and Tasmania. My experience is I've kind of always been with the SMSF side of things, having worked in several large firms, including Deloitte and NAB and Just Super, etc. I've always had a passion for the SMSF Club, for the SMSF in general. I started off with the SMSF Club about 3 years ago and just love the model, love helping clients, love being in contact directly with clients, and also at the same time being involved with the accounting side, which I'm very passionate about. In terms of what we're going to cover today, there's 3 broad topics that I want to talk about. And they are essentially an update on the 2017 federal budget that was announced a couple of weeks ago. The next thing I want to cover in a broad category is what's going to happen when come the 1st of July. I mean, there were quite a few changes that were announced as part of the last budget, and a lot of changes are coming into effect from the 1st of July. It's important to actually understand what's actually involved with these changes. So we're going to go to that secondly. And the third thing we're actually going to cover on is what's going to happen from now till the 30th of June, because we have a different timeline. We've got different laws that apply at the moment, which will be changed from the 1st of July. So what kind of opportunities do we have from now till the 30th of June that we could potentially take advantage of, or what we also need to be aware of until then? Now we'll start off with the federal budget. Now the federal budget was announced on the 9th of May by Scott Morrison. It was an interesting budget because a lot of people expected a lot more than what was actually affected, especially in light of the previous budget we had, where there were a lot of changes made to the superannuation side of things. The focus on this was primarily on the affordable houses, and if you look at it in an overall picture from a professional investor point of view, it had minimal impact on personal income tax, superannuation, and social security. But we'll go through the changes and how it affects you anyway. So this is the second budget for Scott Morrison. And obviously, as I mentioned before, the focus was mostly on affordable housing with some minimal changes elsewhere, which we will cover. Let's look at the budget there are three main categories in there, but I think there's only really two that apply to 99% of the clients, which I'll cover. So we'll talk about personal income tax, and we'll talk about superannuation. Small business we won't cover, but if you are interested in anything to do with small businesses, contact me directly. We can go from there. Starting off with the main change that came about was the increase of the Medicare levy from 2% to 2.5%. It was an interesting one because if you go back to Julia Gillard government, she actually introduced a bill about the National Disability Scheme. And at that point, they introduced the bill and they increased the Medicare levy from 1.5% through to 2%, and that took effect on the 1st of July 2014. Now, NDIS, or National Disability Scheme, was rolled out on the 1st of July 2016. And now here we are again in 2017 budget saying that the Medicare levy, or that 0.5 increase, was not enough, and now we've got to go up to 2.5%. Now, granted that this would only take effect from the 1st of July 2019, but ultimately we will be hit with this increase. So we're talking about, for those who are above the actual threshold, we'll be paying 2.5% of our income towards this, which, I mean, if you calculate, that's quite a substantial amount. Now, the government announced that the revenue generated from this will go towards supporting the National Disability Insurance Scheme. So that's one of the main changes to be aware of. Obviously, it's only going to come into effect after the next election, so we're talking about 1st of July 2019. Obviously, there's some malice in the timing of the announcement. The next thing to be aware of is probably not so much an announcement, but a lack of an announcement, and it's to do with the temporary budget repair levy. Now, you recall on the 1st of July, the government, or a few years ago, the government announced that there would be a budget deficit levy. This is more to repair the deficit that was they blamed on the previous government. Now, this affected people with incomes of over 180,000, but is a whopping 2% on top of the normal marginal tax rate, which would be approximately 47%, including Medicare levy anyway. Now, the fact that the government has not made any more announcements about this means that this will actually cease to take effect, or will cease from the 1st of July 2017 onwards. Effectively, you're talking about high-income earners here, people in excess of 180,000, who pay 47%, including Medicare levy. They used to pay 49% this year, whereas from the 1st of July onwards, that's going to drop back to 47%. So that's a pretty decent thing for high-income earners. Now, the other thing that the government announced, now this is kind of on the back of raising the Medicare levy from 2% to 2.5% from the 1st of July 2019 onwards, they've increased the thresholds being the minimum amount you can actually earn before you'll be hit with the Medicare levy. And this is separate for singles, as you can see on the screen, 21,655. Anything over there, you'll be subjected to the Medicare levy. If you're a family, 36,541, plus 356 for any dependent child. If you're seniors, single seniors, this is 34,244 is the threshold. And then if you are seniors, families, we're talking about 47,670, plus there's also allowance for any dependents that you might have. So they kind of brought this in straight away, but it's almost, you kind of supporting the lower end, and at the same time you're raising the levy at the higher end. So they're trying to get at both sides. The other thing that is changed is the HELP, or the Higher Education Loan Program. Mostly applies to people with tertiary education who actually have a loan with the government. What the government's done is they've reduced the threshold as part of this budget announcement. They've reduced it down to 42% or 42,000, but while they've reduced the threshold, they've also reduced the amount you have to pay. So it's down from 4% to 1%, but at the top end, the maximum they're charging at 10%, which is, it hits you when you've got 119,000. Not many people are going to be happy with it, and some will be. So you've got a mixed response to this announcement. Now, a big one that's come about as part of this announcement, especially for property owners, is the disallowing of certain deductions. Now, this applies to residential properties and takes effect from the 1st of July 2017. You might recall you were allowed for deductions in the past for traveling expenses relating to inspecting, maintaining, collecting rent for residential properties, and a lot of people used to take or claim this in their personal tax returns. To a limited degree with SMSFs, because it's been audited, it's a little bit harder to do with SMSFs, but that's kind of no longer, and it's more of an integrity measure on behalf of the government, where they believe that this deduction was being abused, so they've basically taken it off the table rather than trying to regulate it. So basically no deductions, and this applies to personal. You're still fine to actually engage third parties to do those inspections for you, and that's still deductible. What is not deductible as far as residential properties are concerned is if you are claiming those deductions personally. Now, another big change as part of this is the changes in depreciation. Now, there are two types of depreciation. If you've ever cared to look at your depreciation schedule that you've got, there's normally what they call a Division 40 depreciation, which mostly applies to plant and equipment. Plant and equipment being things like air conditioners, ceiling fans, heating units, anything that you've installed, dishwashers. They have what they deem as a expected life, and you claim a deduction over them. They're called Division 40 depreciations. There's another type of depreciation called Division 43, which basically is a depreciation for the cost of buildings, and that normally works out to be 2.5% of the cost of the building, which is depreciated every year. Now, what the government has said, now if you buy a property brand new, or if you effectively spend money installing these plants and equipment, you will still be entitled to these Division 40 depreciations. But if you buy a property, or you buy a second-hand property from someone else, you won't be entitled to those deductions anymore. You will still be entitled to those building depreciation entitlements, but not for plant and equipment. That only applies if you've actually spent the money and put that into the property. Then you're still entitled to it. Otherwise, it forms part of the cost base of the investment. So that's an interesting one. Now, the other thing that the government, as I mentioned earlier, that there's a lot of focus on affordable housing, etc. Another measure that the government has taken is expanding some tax incentives for investments in affordable housing. I'm not sure how this measure is actually going to go through in terms of being acceptance, but what they've actually allowed is if you invested in affordable housing, effectively housing where you need to register it and you offer discounted rent, as a reward for that or incentive for that, the government saying it's rather than you be subjected to the normal 50% discounting when you sell the property. In other words, if I make $100,000 gain on it, I only pay tax on 50%. The government is saying you only pay 40% tax, or you get a 60% discount, and you only pay tax on that 40%. But this only applies to this affordable housing scheme. All right, moving on from there, another part of the budget is these foreign residents being targeted. As you can actually see, a lot of focus is being taken on these foreign residents who own properties in Australia. Now, the first thing the government's done is they've reduced the threshold for withholding tax. The threshold was $2 million until the 30th of June. Now, that threshold's being reduced from $2 million down to $750,000. Now, not only that, they've actually increased the withholding rate. They've increased it from 10% to 12%. And it's on the purchaser's shoulder to actually make sure that they keep the withholding amount and pay that directly to the tax office. So this is designed to discourage foreign investment, especially for people who actually just buy the house, leave it there and forget about it. Obviously, there's been a lot of noise in the media about foreign investment, so this is just moves to discourage it to a certain extent. The next thing that they're actually looking at doing is removing the exemption. You know how you have your exemption for your primary residence? That exemption is essentially being removed. There is grandfathering. Grandfathering, in other words, that if you already hold a property, you have until the 30th of June 2019 to get rid of it and not pay tax. But if you effectively buy and you're a foreign resident and you buy a property, you will no longer be entitled to that CGT exemption for your main residence. So it's an important one. The good thing for the people who already hold property is there is some grandfathering provisions in there, and they have until the 30th of June 2019 to clean it up. The next topic I'd like to talk slightly on, because there aren't that many changes, is superannuation. There's some interesting ones over here. Now, the first one is the First Home Savers Scheme. It's something that's just been talked about, and it's interesting because we're talking about affordability and first home buyers, and this is an incentive that the government's providing for them to save using their super. So what the government said is from the 1st of July, any individual or who is looking for the first home can make voluntary contributions of up to $15,000 per year, a total of up to 30K. And they can keep it in the super, and when they're ready to buy the property, they can withdraw the money plus the deemed earnings and use that to purchase their first property. The main reason for it would be in super, the maximum tax rate you'll be paying is 15%, whereas if you were taking that money under your own name, you'd be paying your marginal tax rate. So straight away, there's some incentive for people to put into a lower tax environment, being super, and only paying 15% to start off with. Not only that, but you contribute, as you earn income in the super fund, you're still paying 15% tax on that income that you earn on that money, whereas outside it'll be at your marginal tax rate. And finally, when you actually take the money out, which will be after the 1st of July 2018, the taxable portion would be included in your assessable income, but while you still are assessed under your taxable income, you will get a 30% offset. So there's some incentive for the young people who are looking at buying their first property to save this way. It helps if you're a couple. As an individual, you're talking about a maximum of $30,000. Whereas if you're a couple, you can save up to $60,000 this way. And not a bad thing to mention to some of my clients, especially who are looking at trying to get their first property. It might be something that will work for them. The other superannuation changes that we're talking about are contributions. Now, this is more one that relates to the older people all aged over 65. And it's more when they sell their primary residence and they're downsizing. What the government is encouraging people to do by this announcement is put some of that money into the super fund. So people over 65 will be able to make so-called non-concessional contributions, effectively after-tax contributions of up to $300,000 per person from the proceeds of selling their home, but they need to hold that property for more than 10 years. Now, not only that, but the government's gone further to say that the contributions are in addition to the existing contribution caps. So they don't count against the current, this is in addition to it. So as a couple, you can put up to $600,000 into your super fund. Obviously, when you're 65, you're kind of in that retirement phase. You're looking at pensions. It's quite attractive because if you have $600,000 in a pension, for instance, that's earning tax-free income. And not only that, it's also accessible. So if you really needed to pull it out, if you have an account-based pension, you can pull the full money out as well. So it makes a lot of sense. The other thing that's removed any eligibility criteria. Now, in the past, there were work tests that prevented people in the, over 75 from putting money, and also as part of the $1.7 million cap that's going to come through on the 1st of July. That could work as a barrier, but the government basically removed that and said this is in addition to that. Now, one major thing that the government hasn't gone too much about is the fact that if the money is in your super fund, it will be subject to Social Security means testing. So what they're saying is, by all means, put the money into your super fund, but on the other side, they're kind of thinking and saying, oh, maybe we don't have to pay you an age pension after all, because that'll count towards your means testing, whereas if they sat on that property, it doesn't count towards means testing because it's their primary residence. So if you're never going to expect to get retirement benefits from the government anyway, not a bad thing to do at all. Now, those are the main changes that we've talked about in terms of the budget announcement. The next thing I want to focus on is the changes that will take place after the 1st of July 2017. It's pretty important to actually understand the impact of a lot of these changes. The first one I want to talk about is more to do with the simple account-based pensions. Now, account-based pensions, you normally start when you reach your preservation age and you retire, or people get to 65 and decide if they want to start a pension. They normally start what we call a account-based pension. Now, in the past, there were no limits as to what kind of balance you had, and it was very attractive. It means if I had $5 million, for example, I can start a pension with $5 million. It sits under the person's name, and all income that I earn on that $5 million is tax-free. At the same time, if I was over 60, I could essentially take pension payments out, and again, that was tax-free in the hands of that individual. The government's kind of cut down on that a bit, although I've been to a lot of my clients, and not many are really affected by this, but from the 1st of July, there will be a $1.6 million pension cap. What does that mean? It means you can only have $1.6 million in a pension being exempt from tax. It doesn't say you can't have more than $1.6 million. It simply means only $1.6 million will be exempt from tax and provide those exempt tax benefits. Any excess amount would be treated like a normal super amount. In other words, it'll be still subject to the normal 15% tax, which if you look at the overall scheme of things, you've got a marginal tax rate being, the maximum marginal tax rate is up to 47%. If it still stays in super and you if you tax a maximum of 15%, still not a bad result, but you lose that exempt status for anything over 1.6 million. The next change, and this affects pensions, is lump sums do not count towards minimum pensions anymore. Now, a lump sum, most people have a lifetime limit of 195,000, and this used to come in handy for people aged under the age of 60, because if you drew a pension, it wasn't tax-free in your name. So a lot of people would draw a lump sum up to the lifetime cap of 195,000 and not be taxed on that figure, whereas that's now removed. You can still have the lump sum, but it won't. You still have to take your minimum pension on top of that as well. The next major change that's happening from the 1st of July is a transition to retirement pension. This is one of the older incentives where you had a transition period where as long as you met your preservation age, people could start a pension but still continue working. The pension was great because it allows you to have some tax-free income, and it allowed you to earn the income in that pension being tax-free, at the same time work towards retirement. Now, what the government's turned around and said as part of the last budget was you can still have the transition in place. It simply means that it would have no exemption status. It would now be taxed at that 15%. So that's a consideration with this removal. Is it worthwhile for people to still have this transition pensions in place, or is it worthwhile rolling that into an account-based pension? The next changes are more to do with the non-concessional contributions. Now, I'm covering these before I cover the 30th of June, just to give you some context. The first thing that's changing with these is the lowering of the non-concessional cap to $100,000. Until the 30th of June, it will be $180,000, so it's a substantial cut from $180,000 down to $100,000, and it's a bit of planning for people who want to put money in before then. But keep in mind, after the 1st of July, these caps will fall to $100,000. The bring forward rule still applies. A bring forward rule being, if you wanted to, you can contribute up to 3 years worth of contributions at one go or spread it over 3 years. In other words, if you had up to $300,000 that you want to put in, you can still put in next year. The next one we already covered briefly was the $1.6 million eligibility threshold, and the bring forward rules, which I just covered on briefly. Now, the last thing in terms of non-concessional contributions, which I will cover on a slide further down, is increasing the income threshold of low-income spouse offsets to $37,000, and this is an opportunity that people can actually take advantage of before the 30th of June 2017. Okay, now as far as concessional contributions go, the main change over there is a reduction of concessional cap to $25,000. Now, a concessional contribution is effectively your pre-tax contribution. So if I salary sacrifice or my employer puts money, that 9.5% into your super, it's a pre-tax dollar that's going to your super fund. Now, once it's in your super fund, it's taxed at 15%. The threshold has been reduced to $25,000, which is not a great thing because it's a substantial drop. But there's some flexibility around what can be done with it, which we'll cover in the next point, on the next couple of points. The first thing that the government's done is they've removed what they call the 10% rule for personal concessional contributions. Now, this used to be a barrier for a lot of people to make those last-minute contributions because the 10% rule effectively said that if you earned more than 10% of your income from an employer, you cannot claim a deduction for contributions you put into your super fund. The government has removed this from the 1st of July, which makes it more flexible. So in other words, if I earned $100,000, my employer puts 9.5% into my super, so $9,500. And if I wanted to make another $10,000 contribution from the 1st of July, I can just put the money in and claim a deduction for that under my own tax return. Whereas before the 1st of July 2017, you could only do that through your employer organizing salary sacrifice through your employer. So there's a bit of flexibility that's been introduced. The next thing to be aware of is what we call Division 293 income threshold. Now, I've seen a few people being hit by this recently. This year, it is 300,000, but what's going to happen from the 1st of July is if you have income in excess of $250,000, not only do you pay your normal 15%, which is all concessional contributions that are taxed at, but you will be hit with another 15% on those contributions. So essentially, you're talking about up to 30% tax on your contributions for people who earn in excess of 250,000. Thing to be aware of. Now, given the flexibility with the 10% rule being removed, it might even help to do some forward planning and maybe try and contribute it to your spouse, or reduce the amount of contributions if you are going to be falling into that category. The next thing is the introduction of low-income superannuation tax offsets, or LISTL. I'll talk about this in a future slide further down the track, wouldn't be too long. Which again relates to these concessional contributions is, in the past, people under 48, for example, you have up to $30,000 that you could contribute a year. Now, if you could, or let's say you could only contribute $10,000 in 1 year, come the 1st of July, or the resets, basically. So you, again, next $3,000 cap again, and so on. So you basically lose any benefit. What the government's allowed now is you have up to 5 years for a catch-up. So if I didn't use my $25,000 cap in 1 year, let's say I only put $10,000 1 year, I can $15,000 that I could use next, plus the $25,000. So we're talking about $40,000. Continue for up to 5 years. So there's a bit of flexibility in planning, and even if you weren't expecting your money to come uniformly, like you're expecting a bigger payout or the following year, you can plan a deduction during that year. So there's a good opportunity there to work with it and try and take advantage of the amount. Now, moving on to changes before 1st of July that you be aware of or you need to plan for. Covering concessional contribution, the thing we need to talk about here is, sorry, next slide. What are concessional contributions? I've covered them. They are pre-tax contributions, things like salary sacrifice or made by an employer. Now, once these contributions are put into your super fund, as I mentioned before, at 15%. Remember, while I mentioned that the cap is reduced to $25,000 from the 1st July, you still have an opportunity until the 30th of June to make use of your current cap. So if you're under 48, your current cap is $30,000. Whereas if you are 49 on the 1st of July, your cap is $35,000. So if you haven't made use of cap, you can talk to your employer and see if you want to take advantage to get some more money into your super fund. It's perfect. So there's an opportunity to get more money into your super fund before the year end. Obviously, this depends on your circumstances. For instance, if I didn't have much of a taxable income to start off with, it might not make sense for me to make contributions because I'm not getting that much of it based on my marginal rate. And also important to remember the 10% rule, which obviously is relaxed after the 1st of July, but still applies, which means if I earn more than 10% of my income from an employer, I can't action for contributions that I put in my super fund. Okay, moving on to non-concessional contributions, which is a good way to get large amounts of super fund, at least based on the current limits. The current cap until the 30th of June is $180,000. but also is the opportunity to use the bring forward rule. Now, provided people could put, for instance, if I wanted to trigger the bring forward rule, that means I put a single 180,000, which means I can put in up to 3 years worth of non-concessional contribution in one. So as long as it's fully put into the fund before the 30th of June, then there is an opportunity for people to put $140,000 each month. Don't utilize it, and if we go past the 1st of July, there are several transactions that will apply, transitional rules. And the concessional contributions, also keep in mind that there are rules in after the 1st of July. We're talking about a lower cap, we're talking about 100,000 after the 1st of July instead of 180,000 at the moment. Now, have transition to retirement pension, it's important that you actually consider across to an account-based pension if you can, or you fulfill the criteria for. As mentioned before, the transition to retirement pensions will no longer be. So for those who can, consider moving it across. The thing you want to do is review your insurance contributions. Now, in light of the fact that you're actually looking at lower contributions going into your super fund, especially people who have these massive premiums that they're paying for the insurance, they might be considering like maybe paying the income protection from your personal rather than first. So there's a bit of planning that you can actually work around with. And the that you want, which you should do every year anyway, is review estate plans. Estate plans make sure things like your benefits are in place. Think about for those who can withdraw money when it's worthwhile and you don't even non-dependent, it's worthwhile withdrawing money and recontributing money to the super fund. Be a good idea. If you've got any questions, best to contact your coach about it and talk about it in a little bit more detail. Now, the low-income super tax rebate. The low-income super tax rebate is for people with under $37,000 in income. The government will rebate your super contributions tax up to $500. The main rationale for this is simply this. If I had earned $35,007, I'd pay 5% in contributions to my super fund, which works out to be $2,333. And the tax on that, once it's in your super fund, is 15%, which works out to be $500. So effectively, the government is saying, we'll give you that tax primarily because you are in those income brackets, and if you had taken it personally, you wouldn't have been paying that. So they're giving you this rebate of $500. Earning under $35,000, you might be missing out on some of the $500. Now, to receive this, you need to make concessional contributions, which is of up to $3,333 into your super fund. The next thing to consider before the 30th of June is, can you take advantage of spouse contribution? Now, a spouse contribution is you make an after-tax contribution for spouse's super. So you need to make up to $3,000 to get the maximum benefit. Now, you can claim up to 8% or $540 a tax offset on your return. In order to qualify for this, your needs to be earning under $13,800, which is not a huge amount at the moment, but that will increase until the 3rd of June. Be earning $800, and if you deduction the $10,800. Now, from the this is actually makes it a lot more reasonable, but until the 3rd of July remains low. But from the 1st of July, cap goes up to $30, which is a much more reasonable amount. Okay, now the I want to here is government co-contribution scheme. Something to consider prior to June is the government will contribute a maximum of $500. Now, this has to be on incomes under $30,000. So the contribution into your super 50% for every dollar you put in. So if you put $1,000, you get $500 to the government. So it's not bad. Now, the contributions are after-tax contributions or non-concessional contributions. And if you earn under $51,000, $51,021, you are still eligible for some co-contributions. The main broad topics that I wanted to talk about today. As part of my next slide, I just want to cover a few little things with SMSF, especially in light of a lot of the tax returns that I've been looking at recently. It's important to remember that SMSFs are subjected to the same rules as larger funds. So it's a highly regulated market, and on occasion I come across a fund where people are not aware that it is subject to such strict guidelines. Now, the government takes people's retirement funds very seriously, and there are lots of rules in position to actually protect your retirement funds. For instance, every year your fund has an obligation to prepare financial statements, which we do on your behalf. Now, every super fund return and financials, as well as all the supporting documents, is audited by an independent auditor every year. Your income tax return needs to be lodged with the ATO. For those who haven't got their tax returns back to me, if you can, that'd be great. For those I'm waiting on information, please send that through to me as quickly as possible. The next point to focus on is the sole purpose test, and this is the foundation of why people have an SMSF, to provide for retirement benefits when you actually retire. Nothing, you cannot mix up your money with your current monies. You can't use it as a loan account. You can't mix up the names. It's important to always mention that integrity of your self-managed super fund. Now, the last thing on this slide is a super fund must be maintained for the purpose of providing benefits upon retirement, which goes to the foundation of what the sole purpose test is. Important to remember what I've compiled as, and I call the 10 Commandments, always gives you an idea of what to do and what not to do when you're talking about your self-managed super fund. The first thing is thou shalt remember that you're always in control of your super fund. And this is quite different to your industry super funds where you could pick up the phone and call someone if you had a complaint. When it comes to an SMSF, you are in control. Ultimately, you are responsible for everything that happens in the super fund. Playing stupid when it comes to a contravention with the ATO, they don't take that lightly because as far as they're concerned, you should know and you are in control. You're a director of your corporate trustee, you're a member of the super fund, you direct everything that happens in your SMSF and you benefit completely. The next thing is covering on the sole purpose test anyway, but remember that whatever you do with your SMSF, it's always to provide for your retirement benefits, nothing else. Now there is a document that every single super fund has, or self-managed super fund has. It's called a trust deed. Now in addition to the law, it also forms the rules of your SMSF. I know most people are not even aware of what's in it, but it's a good idea to, every time you make a major decision in your super fund. For example, you look at your property, you want to buy a property. You need to look at the rules of your SMSF. Or if you're starting a pension, can you borrow money? You need to look at your rules of your SMSF being your trust deed. And you'd find that especially when you look at property, the banks would actually ask for this document because they want to see the rules. Now, the SIST Act is an act that governs your super fund, the Industry Supervision Act. That basically dictates what can and can't do, that you can and can't do in your SMSF. This, in combination with your trust deed, forms the constitution or your basic rules about what you can do in your super fund. The last thing that you need to consider as far as rules are concerned is a document called an investment strategy. It forms part of your annual document or something that you review every year. It's not just a document that you sign off on every year and not read what it's all about. It's important that you actually give some form to it. You actually work with the strategy of your long-term goals, what kind of returns you're looking for, what kind of investments you're looking for. So all that needs to be reflected in your investment strategy. So pay attention to these documents as they come through in the year end and maybe give rise or formulate some decent strategies. Now, do not break any investment rules. Very important. Investment rules are things like you shouldn't be putting it under your name, your personal name, when it should be in the SMSF name. You shouldn't be investing in certain investments that are prohibited, for instance. So keep in mind, if you want more information about what the investment rules are, shoot me an email. I'll be happy to send them through to you. And the next one is thou shalt arrange for your SMSF to be audited. Now, obviously, as a member of the SMSF club, we organize this for you as part of the annual process. But we do send that to an independent auditor, and they go through it with a fine-tooth comb and sign off on it. Thou shalt lodge tax return and compliance return. We prepared this for you, but I can't complete it without your help. So if you can send me information in a timely manner, that'll be great. And once we launch the tax return, we're pretty much done for the year and get ready for the next year. Now, you should keep your fund separate from your personal finances. This is probably one of the biggest contraventions across the industry where people do not keep things separate. They accidentally mix the funds up with their self-managed super fund, or sometimes they're in a tight squeeze, they feel they need the money and they quietly pull the money out of the self-managed super fund. Any breach is reported to the ATL, so be careful with these things. And finally, if you feel it's above you or you can't contemplate what it's all about, seek professional advice when necessary. Now, with that, that's pretty much, I've covered all my slides here. Justin, are you there?
Yes, Gavin, I'm here. Thank you, mate.
Sure.
Appreciate that in-depth analysis of the current changes, tax and superannuation. We do have a few questions that have come through. On my question thing, it's probably easier to start with the last one first. Question is there a maximum amount the government will match, referring to the government co-contribution scheme? I think you're talking about how if you contribute, if you meet the income test, $1,000, the government will match it with another $500 co-contribution scheme. So that is the maximum amount. If you contribute $500 in a non-concessional contribution, it's 50 cents of your contribution, so it'll only be $250 in that case.
Correct.
So going up, there's a question there that it's a pretty long one. Maybe can you see the questions, Gavin, at all?
Not really. Let me
I'll go through. Hi, Gavin. If we contribute additional super to our SMSF above the maximum of current concessional cap in 2016, if we contribute more than 35 grand, is the Division 293 rule currently affect us?
There's two things that could happen. So if you exceed your cap, the first thing that's going to happen is any excess of that any dollar over the 35,000 will be assessed under your marginal tax rate. So let's say if you put in 40,000 instead of 35, that extra $5,000 will be assessed under your marginal, so you'll be paying tax under your marginal tax rate.
So
You
if you're
will
on the
get a credit for the...
if you're on a 30% tax rate, that $5,000 you tax at 30% in your personal name, rather than the 15%
Correct.
that applies to the 35,000.
Correct. Correct. Now, the 293 does not necessarily apply. The 293 will only apply if your taxable income for the 2017 year is over 300,000. So if you had more than 300,000 and you had a concessional cap and you broke into the concessional cap, yes, you'll be hit by that. But if your taxable income is under 300,000, you won't be hit with 293.
Yeah, another question on the $1.6 million threshold. If some of the super is held in a property, would they value the property to work out the 1.6 million?
This is kind of, yes, they will. They do value. So when you start a pension, the property will be valued. So, for instance, if it's gone up in value, we'll need to run a valuation. If it exceeds the $1.6 million, obviously you've got a problem there that we need to work with, and any excess will be treated effectively like an accumulation account.
When you talk about a problem, you talk as if it's a huge problem. It's only any income on the assets held above 1.6 million are taxed at 15% tax rate, right? So it's a pretty good problem to have. If you held your assets in your own name, you're probably going to be paying a lot more tax than the 15% above that threshold. A question is whether or not that is the net property value or the total value. So if we've got a property worth $2 million and there's $1 million debt, are we over the $1.6 million threshold, or are we below it?
That's an interesting question, because there has been some proposals with the government to try and include that. Now, that we won't know the exact result of it until it goes via Parliament, but that's debatable at the moment. We need more clarity on that number.
Yeah, sure. That was my question.
Yeah, my inclination would be to say the net value, but there has been a proposal to the government to include the LRBA debt.
So I'll go back down. A question for you, Gavin. Like, what's the biggest step forward in the superannuation legislation? Or what's the biggest positive, do you think, out of all the changes, whether it's the proposed changes in this budget or those coming into effect on the 1st of July this year?
In terms of what I like, the biggest one I like is that admitted there is a reduced cap of $25,000. I like the flexibility around it. It's something that you can play with quite a bit. I mean, even if you include your spouse in it, there's lots of room to move with it. And something I want to do every year is just make sure we maximize it and try and plan for the future. So it's something that we can certainly play with.
Yeah, I agree. It's certainly a big step forward when you can carry forward unused concessional contributions, and also in addition to that, where you can make your own concessional contributions into super rather than relying on your employer to salary sacrifice on your behalf. I think they're huge steps forward that make super more flexible and more accommodating for more individual Australians rather than just the normal PAYG income earner. What's the biggest negative, Gavin?
Oh, I don't like the 1.6. I know it's not a bad outcome, regardless, because you'll still be taxed concessionally for any amount above the 1.6. But the fact that they've actually reduced the amount you can put in terms of non-concessional contributions, and then at the same time hit the upper cap of 1.6, I don't like that. I don't like that, because it kind of, in a lot of people's mind, it puts a limit, even though that will be indexed in time.
Yeah, look, I agree with your comments there. The biggest problem overshadowing the superannuation industry is the government continues to change the rules. And while they continue to change the rules, a lot of Australians are going to lose faith in the superannuation system. And I think that's the biggest step backwards that the government can make. If we just stick with the rules and not change it, I think Australians will trust the entire superannuation system, be willing to contribute more to superannuation because they have more certainty around that. And the more people contributing more money to superannuation means that we're going to become less of a burden to the age pension and society. With affordable housing, can existing property be moved into that scheme? I'm not too sure what scheme we're referring to there. Gavin, talk about a scheme.
I'm not. Sorry, what was that, Justin?
Did you talk about a scheme initially on? I grabbed it.
I did. So that's part of the announcements with the budget, where they've got the affordable scheme, where they're encouraging people to put properties. In terms of the actual detail, whether you can use an existing property, I just don't have enough clarity on that to give you an answer. But if you perhaps, Justin, if you can maybe shoot me the details, I'll be able to do some more research and respond to that question.
Sure. And finally, just looking at the time to finish up on, Gavin, I know it's a topical question and it comes up in a lot of different meetings. Right now, as an individual investor, I can transfer into super shares, I can transfer managed funds into shares, I can even transfer business real property if I had one as a in-specie transfer. Will the government ever relax the rules to allow a residential investment property to be transferred into super? And why don't they?
They don't, because it's open to a lot of manipulation, especially when you start talking about related parties and prices, when you bought it, when you transfer it, and that's essentially one thing I don't see happening in the foreseeable future. Whereas commercial properties are quite different. You tend to lease it out to a business. It tends to be at an arm's length. It's hard to maintain that same integrity with residential property, which is why they tend to stay away from it.
Sure, well done, well danced around that question. Look, thank you again, Gavin. A lot of good things that we can all apply to our own circumstances to look at taking advantage of getting more money into superannuation this year before they reduce those caps starting in a few weeks' time. And also to not just get more money into super, but to save some things in tax. So I really do appreciate each and every one of you for tuning in today. Making sure you comply with the superannuation rules is a big integral part of being a trustee of your self-managed super fund. Staying on top of the curve with regard to tax obligations is also a good thing. So thank you for tuning in on this Wednesday night and staying around for the full hour to hear about tax. So good night, happy investing.
Thank you, everyone. Bye.